Hey guys, it's Kieran. In this session, I'm going to talk about 15 expensive trading mistakes. And these are lessons that I've greatly learned in the hard way through my own experiences. And hopefully you'll get a lot of value. And just remember also, a smart man learns from his own mistakes, but a wise man learns from the mistakes of others. And so I ask you, why do you have to make the mistake? Surely you could just learn from someone else's mistakes and you could just apply the lessons. And to some degree you can, but ultimately as humans we're programmed. We only remember lessons when we've actually gone through it ourselves. Otherwise it's just unrelatable. There's also certain aspects of the brain as well, like the amygdala and the hippocampus, which is very much related to emotion and memory and fear. And so we have to learn these lessons the hard way often, and so to make the memories and all stick in our head. The first expensive mistake is this. Markets evolve, and so ultimately your strategy has to evolve as well. Do not get attached to one specific strategy in trading. There's so many different market conditions. There's a trending market, there's a sideways market. Initially when I started, I was a bit weaker from the actual sideways market. And what happened was I was making money from the trending market, but then I was losing it and giving it back in the sideways consolidation market. But now I'm actually a lot better at the consolidation market. And so through time, I've realized that you have to have different strategies for different market conditions. Another thing is that I found it so frustrating. Of course, there are traders that just do patterns and trend lines and channels. And that might work if you're a very experienced trader for many, many years. But even if you are an experienced trader, you can still lose at that. And so another thing is I've kind of gone away from this discretionary style of trading to a more objective, quantitative, statistical style of trading, in which I have specific entry and exits that are actually can be quantified and not subjective. And I'm actually really exiting at specific points as well, as it really helps to remove emotion. Next mistake. Honestly, I would avoid rules of thumbs in trading and investing. For example, Santa Claus rally and sell in May and go away. Yes, these things do sound sexy, specifically in things like Twitter and all, but I personally don't even follow Twitter anymore, because very often these things can really lead to blind spots in your trading, and ultimately it can make you overlook things. And it can greatly make you be heavily reliant on these fundamental things to the expense of the actual objective charts. And so I do believe that such biases will wreck you in the long run, to be honest. And ask yourself also this, when has this ever actually worked out? Like, just think about it. Like, the last time, for example, the Christmas rally or Santa Claus rally, did it actually happen at the start of Christmas? No, it happened like at the last week. And so the problem with these statements is that you could say it, but you don't know exactly when it's going to actually apply. For example, sell in May and go away. The general conventional wisdom is that people are going to go on holidays in May. And so naturally they might want to sell off all their stocks and shares or their assets. And so they might want to spend that and just come back and start fresh. But in actual looking at Bitcoin history, for example, in the actual 13 iterations, I believe that actually 6 to 7 actually had huge downfalls in the actual price. But the remaining were mostly flat and in some cases very, very positive. And so specifically to Bitcoin, I don't think it's really fair to say the principle actually applies, sell in May and go away. It's just, I'm very much driven by data and statistics rather than subjectivity. I used to be like that, but now I realize that this is a profession and a business, and it will, ultimately these rules of thumbs will wreck you in the long run, I believe. But it's useful to be aware of, right? Perhaps there is a political element to sell in May and go away, if you understand what I mean as well. So of course these sayings do have some weight, but again, don't take it blindly. Next expensive mistake. I realized that I need to be able to live to fight another day. In this game, we're dealing with probabilities, not certainties. And ultimately, your risk management, as unsexy as it sounds, really determines our longevity in this game. And the reality is, I always speak about, for example, if you're playing sport to a very high level, it's harder to remove a bad habit than to learn a new habit. Because very often, when you've learned a new habit, there's muscle memory. And specifically when you're a young child, I speak about the example of how I play tennis. I started off with a one-handed backhand, and it was not great. I developed that habit from badminton, but it was a really weak point in my game in tennis. But actually removing the one-handed backhand and going towards a two-handed backhand was actually quite difficult, because I was essentially removing a bad habit in that particular context and learning a new habit. But then someone else who just had not played tennis, but just learned a two-handed backhand from scratch, actually found it a bit easier. And so very often trading, you might have bad habits where you, for example, you don't stick to your stop loss. You just move it down further. and just trying to keep shoving your liquidation price further and further away. But ultimately, this can be to your detriment, because eventually you just might get your whole account wiped out. And the reality is that trading is such that you can have a lot of mistakes. For example, moving your stop losses, etc. And you might get away with it. But there will be that judgment day where you can get completely wrecked out and get wiped out. And so that's the thing. Ultimately, the goal here is to live to fight another day. And next mistake, number 4. I realized to really need to treat each trade individually. And what do I mean by that? For example, say if you have a string of wins. It's like flipping a coin. Obviously, your strategy would hopefully have a 70 to 80% win rate. Of course, the risk-reward ratio is important as well. But if you flip a coin, for example, it's a 50-50 chance. Just because you win the first 4 flips in your favor, it doesn't mean you're going to automatically have a higher likelihood of winning the next coin flip. Each coin flip is independent of each other. So in some sense, the outcome of the trade is independent of the previous one. It absolutely is. You also have to appreciate that each great loss actually also started as a small loss. And so do not get overconfident and just stay grounded as well. One of the major problems is when people experience very good success early on, when their actual competence does not match the confidence, and then it can really get to the head. And ultimately that can be leading to the demise later on. And so this is also relating to this risk management. I also speak about this in previous videos as well. You can vary the risk of your trade based on confidence and also your account size. For example, if you have a smaller account like $1,000, you might decide, okay, it's a small account. If I lose it, it's not the end of the world, but you might risk maybe 1 to 2% on average trades. If you're a bit more confident, 2 to 3%. As you increase your account size, if you're less confident, maybe 0.5% to 0.25%. Maybe more confident, at the most 1 to 1.5%. And as you get further and further in the 6 to 7 figure category, you have to really be risking 1/4 to 0.5% of your account on every trade, at the most 1% if you're confident, because ultimately you have a lot more to lose. Your losses and gains are just exponentially amplified. And so you have to appreciate that the habits in smaller account sizes will greatly be reflected in larger account sizes. So expensive mistake number 5. People always have this misconception that, okay, I have a small account, I have a $100 account. Once I become rich and once I make $1 million, then I'm going to focus on doing things properly. But the reality is that money doesn't change you as a person. It just ultimately amplifies who you already are. If you were greedy before you got rich, you probably are going to be greedier when you get rich. If you were generous before you got rich, money probably gives you the opportunity to share that joy with everyone else. And in similar ways, I'm of the belief, and I genuinely want to conduct a study on this, I really do, I'm of the belief that 80 to 90% of traders just screw up in trading because they feel they have a small account size. And so they feel they need to make it all back. They over-leverage themselves in a single trade, ultimately leading to the demise. And the reality is that regardless, you need to know how to trade anyway, even if you've got a small account or a large account. And believe me, I will speak about this later. If you have a small account, if you're consistently able to bring 3, 4, 5, 6% every single month, and that's compounded, etc., you're able to do that with a larger account as well. Do not focus on the size of a trading account. Instead, focus on being the best trader you can be. Really focus on producing high-quality trades, and the money will essentially find you if you're consistent. Expensive mistake number 6. Really separating objectivity from subjectivity. For example, we have these external news events. I don't know, for example, you see the interest rate going up, you see an FOMC meeting, and unemployment claims. Yes, these things might say to you, okay, I do not want to trade in this particular aspect of the day, but saying the statement, I think it's going to go up or down, is not good enough in trading. It's going to get you wrecked. Trading is a rule-based game. Yes, people have intuition. Some people say that. But this is coming from extreme and an intense amount of chart experience. In some cases, 10 to 20 years, some of the people we know in this chat as well. You have to realize that, of course, many strategies have an element of subjectivity, but there has to be an actual objective component to it. And this kind of subjectivity is going to get you wrecked ultimately. Expensive mistake number 7. Invest and trade only what you understand. Really try and stick to your lane. What I mean by this, if you, for example, are trading commodities, oil, for example, but then all of a sudden you get involved in crypto or stocks, you might get wrecked. Because you have to realize that each asset class has its nuances. Me personally, I've really decided to really focus on gold and crypto. I like the way the assets trade, and I just like the fundamentals, but that's not so important in regards to trading. But I like the way they respect technicals, and it's something that I really understand as well. It's something I'm passionate about. And this is another thing. It really helps if you're passionate about the instrument. For example, oil, I just feel there's a lot of institutional interest, and I feel I don't know enough about the nuances to trade it. And in some cases, technicals, of course, are important, right? But there's certain nuances that you might not know, and you need to. And I always say, for example, if you're starting off with crypto and trading, imagine there's a pyramid to growth, and you get to the top of the pyramid. Of course, the skill set you have from one asset class will translate onto the next asset class, but whenever you're starting a new asset class, you might be starting from the middle of the pyramid, and so there is an element of research to be done, so I have to appreciate that as well. Expensive mistake number 8. Understand your trading style. Are you a scalper? Do you like more consistent gains, but a smaller, more modest gains, but you like to have a really high win rate of like 70 to 80%, but your risk-reward ratio might be a 1-to-1 or a 1-to-2? Or would you prefer being a swing trader, where your equity curve does not go up in a straight line, but it's a bit more, it faces large swings, as the name suggests, but you have the luxury of being able to just have freedom of time in that sense, in the sense that you only need to make perhaps one trade a week, potentially, and get the same result as a scalper. But then again, are you prepared to enter a trade, lose a trade, and then perhaps only wait another week for the next trade setup, or maybe 2 weeks? A lot of it is dictated by personality type as well, but the reality is that you could be a bit of both. I would classify myself as 60 to 70% swing trader and 30 to 40% scalper. And this is the beauty, you can do both. I just ensure that my overall risk is not overexposed to more than 2% at the most at any given time. Perhaps you might decide trading isn't for you. Maybe you might decide to be an investor. But the thing is that even basic trading knowledge will really come hand in hand in investing. For example, the crypto bull run last year, in 2021, 2022, the second high of Bitcoin around that deviation play, if you understood technical analysis, you would realize that it was just a deviation play. And so sometimes another point is that sometimes people just need to change their actual strategy rather than their actual style. And this is a mistake as well. So when I started trading, when I was not profitable like I am now, I initially thought the problem was the fact that I was scalping or swing trading. But then I realized that that wasn't the issue. The issue was actually the strategy. People always forget this, okay? And so really try and focus on this rather than just being adamant that's your actual style. It may be that, but you cannot sort this actual trading style out before you sort the strategy, right? Expensive mistake number 9. Everyone's journey is very different in trading. Generally speaking, it takes 2 to 5 years to be a professional trader and consistently profitable every month, at least. Some people are able to do it in the first year, but it's very different. Everyone's journey is different, and do not compare yourself to other people. It's also relating to this. I explained how there's so many arms of being a consistently profitable trader. For example, trading psychology, risk management. But you have to appreciate that everyone's child development is very different. In psychology, we have things like negative reinforcement, positive reinforcement, operant conditioning. And so ultimately, our childhood really dictates our attachment styles. And the reality is that this can translate into our trading. 2 people could have the same strategy, but one person could have more emotional discipline. I can be a really stubborn person, and so this, for me, my trading psychology is quite good in that sense. For me personally, having had no financial background, I actually found these 2 aspects come naturally to me a bit, and so this helps as well. But other aspects don't come naturally to me. For example, all this financial lingo and stuff, all that I've had to learn on my own, but then I've realized with time that all that's not that important. What's more important is actually a combination of strategy and trading psychology. Ideally, you want to be like a 7 to 8 out of 10 across all of these. The problem is that if you're at 8 out of 10 for strategy and this, but if you're not an 8 out of 10 for this, then you're going to be screwed. Another thing, as trading, we are athletes of the chart. If you're at the phase in trading where you're breaking even every month, you should congratulate yourself, because that's a huge milestone. Because that means that you're able to make good trades, but your good trades are just being diluted by your bad trades. And you just have to sit down, journal, and really find, okay, why is the specific bad trade not working at this time? And if you're able to cut down on your bad trades, you're able to amplify the progress from your good trades. And eventually that can lead to exponential profits. It takes so many years to be an engineer or a lawyer. And so surely with trading, we should have that same level of commitment and realize that we should be focused on the process and not the actual end result. And this touches on a previous mistake. So expensive mistake number 10. Understanding your circle of competence. Do you like trading commodities? Do you like Forex, stocks, bonds? If, for example, you trade stocks, but then there's some kind of announcement about bond interest rates, then do you all of a sudden just jump to bonds? No, because ultimately, just because you can trade something, it doesn't mean that you should. You should understand that everyone has a circle of competence. For example, Warren Buffett, his circle of competence, for example, is like stocks, but crypto, I don't think it gets it, to be honest, in my humble opinion. And so he actively was quite vocal about shorting Bitcoin, like in 2021. He would have got wrecked. And so we have to appreciate that every investor and trader has their circle of competence, and eventually the circle of competence peaks. And then as you get older, you might not understand the technology as well. Expensive mistake number 11: make lessons cheap as possible. This is actually my biggest regret. If you have, say, for example, sake of argument, because it's a simple number, if you have for example, a 10K account, why not just start off a demo account for 2 or 3 weeks, make the mistakes, and then even when you go live on an actual account, you're still going to make some mistakes, but why not take 80 to 90% of that 10K and put it away and just trade with the 1K? And then if you've proven to yourself that you get it and you're able to be consistently profitable, then slowly drip feed more in. And that's just a potential option as well. The market's always going to be there. Like, think about it. When you entered a trade last year and you messed up, was the market gone a month later? No. Was it market gone a month later after that? No. The market's still here a year later. It's not going anywhere. So once you have a system, you're able to consistently extract profits, right? Expensive mistake number 12. Understanding luck versus actual skill in trades. I think you have to always ask yourself, if you want to trade, did I get lucky today, or did I actually do the right thing? The problem is that bad habits and mindsets can really compound, and it becomes very dangerous when we attribute luck in a trade to actual skill. And specifically relating to this curve, initially you might have that initial spike because of making money, because we had some lucky trades, but eventually we'll lose confidence because we realize that our confidence does not actually match our confidence. You can be overconfident here, but your confidence might have very little show for it. You have to have a system, an algorithm, which you can consistently follow. And I always say that just because you're consistently profitable for 2 or 3 months, it's not enough. The real test is, are you consistently profitable across 1 to 2 to 3 years? Because by then you've gone through different market conditions. You've gone through different economic conditions as well. Expensive mistake number 13. Overconfidence does create blind spots. Do not let positive past trades get to your head. This ultimately will limit growth and areas for development. For example, I thought, okay, I really like this quantitative style of trading. I like the style of rule-based trading where I enter and exit and just no motion. But then I realized that there's certain aspects that I can improve. For example, Elliott waves, harmonics. This can really help my macro view and ultimately influence, okay, when should I have exceptions where I should leave a portion of the trade to run longer? And by doing that, I can actually perhaps let that last 25% of the trade to run and potentially make more than a full week of scalping. And so realize that this is a constant development process. You have to realize that there's always learn to more. Even if there's a trader which you feel is significantly inferior to you, you're always going to learn 1 or 2 things from that person. Ultimately, pride does come before downfall. The problem is that you don't want to be too successful early on, specifically, because it can really get to your head. Expensive mistake number 14. So a stop loss is essentially at which point do I accept that I'm wrong. It's not so much what is the maximum amount of my account that I'm prepared to lose. This is a complete fallacy. And over 90% of traders should be using a hard stop loss. You might see on occasions why certain traders might use a soft stop loss, but then again, they might have the luxury of being able to sit in front of their laptop really mechanically and being able to monitor the position in real time. Me personally, regardless of my situation, I always have a hard stop loss. This is just a set rule. So I'm quite rigid about certain things in trading. I'm always rigid about the stop loss and the first 1 to 2 take profits. The rest take profits. I'm not as rigid because I know I have the discipline at this point in time to close it whenever I reach the key level. But sometimes if I see the reaction and if I think, okay, it's very likely it's going to go up further, then I might just let it run further. You also have to appreciate that a small negative position, simply by you just doubling down and moving your stop loss further down in an attempt to actually push your liquidation price further down, might actually spiral into a much bigger loss and eventually do an account wipeout. I still remember the day when I initially started trading, my first year of trading, when I did so many good trades the whole month. But then I really got to my head. But then towards the end of the month, I realized there was a wick. And so I just removed my stop loss, but the price still dipped. I just kept adding and doubling down and moved my stop loss further down, just thinking, okay, if I push it down further, eventually the market's bound to reverse. But then what happened was the market went further down, and ultimately I was just liquidated, and it pretty much led to a significant portion of my account being wiped out. And that negative experience Even though I had that experience, prior to that, I was always told you should always use a stop loss and you should not remove the stop loss. But reality is that we're just humans. Until we actually go through the pain ourselves, it's very hard for that information to be coded in our brain to really understand to not make the same mistake again. And so since then, I just don't even use a soft stop loss. I'm very rigid about having a hard stop loss. Yes, I could get wicked out, but at least I can live to fight another day. Expensive lesson number 15. Honesty and accountability is just so important to your actual longevity in this game, but also progression as well. For example, are you more focused on being right or rich? There's an expression how amateur traders are focused on being right, but professional traders are focused on making money. If you're wrong, that's fine. Just cut your losses, move on to the next setup. There's always a trade for another day. We're not really being rewarded by being right. We're more being rewarded based on taking high probability setups, but managing our risk. And ultimately, journaling and reflecting is just so important as well. It seems quite monotonous and very laborsome, but ultimately, to be a professional, we have to really see, okay, so why did we take that trade? What was the entry? What was the stop loss? What was the market condition? And specifically, what strategy were you using? Was it a particular time frame during the day? Were you entering before the US session? And were you entering after the US session? It's just shocking, but even these fine details, for example, entering before and after the US session has greatly helped. For example, I realized that eventually, for certain scalping strategies, it's better to actually trade and wait 30 minutes after the US session open. And so, for example, in the UK time, that would be roughly 3 p.m. And so these little things can really give you an edge. And if you're able to really improve by 1% every day, over the long run, those improvements are really going to compound. And it's very important to actively make steps to avoid mistakes. At the end of the day, this is just something you're proving to yourself. What you tell other people will not matter in the long run. Eventually, people will go on with their own lives. And ultimately, it all comes down to you. But yes, guys, that is 15 expensive lessons that I've learned from my own experience of trading. Do check out my YouTube channel. And this is where I post things like the recordings and just my passion for crypto and trading and various market updates and tips about trading. I hope this session was helpful and relatable as well. And thanks a lot guys for watching, and I'll catch you in a bit.